start recording.
Okay. All right, shall we get started? It's at my Western time, 7:30 a.m. So good morning, everyone who's from the same time zone. Good morning to who's from the Eastern time zone as well. And good evening for people for the Asia area, including our presenters, right? Okay. So today we're very happy to have Haifeng presenting this very interesting paper on decoding risk, neutral topic modeling of corporate risk disclosures and expected returns. Now, a few ground rules before we open up the presentation. First of all, please mute yourself at all times. Except for the time that you wish to speak up and ask questions, but please allow 5 minutes uninterrupted time for the presenter to start the presentation first. And if possible, feel free, or I would really encourage you to share your videos to allow more active participation and interaction with the presenter. You can raise your hand or type in the chat box, okay? And then we will have a brief introduction of Haifeng. Many of you may have known him from the previous series of the same event. So Haifeng graduated from UC Berkeley, and he spent a few years in HKUST. So I had the privilege of being his colleague there at HKUST, and now he is the chair professor at Tsinghua University, SEM. So he's an expert in accounting formation, capital markets, and real economy, and more recently in artificial intelligence and investment. So I guess this project is more related to his lateral expertise. So without further ado, I'll hand the floor to Haifeng. Please take it away.
Okay. Thanks, Xinlei, for the introduction. And again, many thanks to Steve and Ayun for organizing this event. Just Ayun and I just discussed, I've been attending this event for several times, and in the past few times, each time I got very good comments. So that's why I'm very eager to come back and present this paper to the audience here. So this paper was co-authored with my former colleague at HKST, Alan Huang, who is also at this virtual event, and also another PhD student at Tsinghua University, Rongyang Ma. So this is a relatively new paper. So we just finished writing the first draft a couple of months ago. So it'll be nice to hear your feedback. Okay, so the first, so this paper is about expected return, estimating expected return. Also, we call it expected return proxy. So first, I'm just spend a little bit of time talking about why that's important, I guess. So everybody know that it's important already. For investors, right? Investors need to have an expected return in order to make their informed investment decision, right? To construct optimal portfolio, right? For firm, when they need to for capital budgeting, right? They need to know their expected return, required rate of return, the cost of capital, etc. Right? And for academic research, we have a very large literature on the determinant of expected return and also on the estimate of the expected return, right? So even though it's very important, they appear there doesn't seem to be a very ideal proxy yet, right? The existing expected return proxy are often empirically motivated. So they're not necessarily related to firm risk, even by construction. And some of them empirically have even negative association with future realized return, right? So what we want to do in this research is try to understand is whether the risk factor disclosure provided by corporate managers in their 10K filings, whether this disclosed tax risk are useful for the estimation of firm-specific expected returns. So just some background, right? So if we believe the theory, according to theory, expected return should compensate for risk. And according to CAPM, right, which is still perhaps the most influential theory about expected return. So the only risk that should be compensated is market beta, right? But empirically, we all know that beta perhaps does not do a great job in describing the cross-sectional stock returns, right? Pharma firm French has a series of paper and basically draw a conclusion that beta is dead, right? And on the other side, there's a lot of research has documented other firm characteristics that have some prediction power in terms of cross-section stock returns, right? We all know about size effect, value effect, momentum effect, etc. And perhaps in the last couple of decades, researchers even discover a zoo of factors, right? So hundreds, even like a couple of hundreds of factors has been discovered by academics and professionals, right? So people have starting to use those cross-sectional firm characteristics to estimate expected returns, right? But there's a couple of problems. One is a lot of those characteristics are kind of discovered as an anomaly, as a symptom of equity mispricing instead of compensation for risk, right? There's also a concern for p-hacking. Maybe some results due to kind of spurious correlation, right? Due to data mining, etc. And the final is also because there's several hundreds of them. Many of them are highly correlated with each other. So there are not so many independent information according to some recent research. Right? So just here a quick review of the existing proxies, right? So for all accounting researchers, right, we must all know this implied cost capital approach very well, right? So that's one of the contribution, right? We accounting scholars made to the literature. So the basic idea is very simple. Just we estimate expected return by equating the firm's market value to the present value of its expected future cash flows, right? Basically, we solve for the implied discount rate. Here I give an example of Gebhardt et al. 2002 that kind of construct empirical proxy following this approach. So we know that when we estimate the implied cost of capital, we need to provide the future fundamental forecast, right? Earnings and growth forecast. But those forecasts can be noisy. And if you use analyst forecasts as a proxy, and we all know there's a literature showing that analyst forecasts can be biased. So if we use a biased or noisy proxy on the numerator, so when we solve for the implied cost capital or the implied discount rate, the noise will go to that discount rate as well, right? And to kind of mitigate the problem, and people some some study propose a model-based forecast, such as Ho et al. And Lee and Moharam 2014. They develop a earning prediction model and forecast future earning and use a forecast earning as an input, right? But there's another issue is that because you infer the cost capital from the stock price, and the stock price sometimes can be overvalued or undervalued, and this like equity mispricing can also affect the cost capital estimate. So therefore, the resulting measure may not necessarily be kind of a reward for risk, right? It could also reflect mispricing as well. So the second type of proxy, what we call a factor-based proxy. So this basically a extension of the CAPM. Here I give example of Pharma French three-factor models, right? So basically, when we use a factor-based approach, we just estimate the expected return as the risk-free rate plus the sum of a beta times the expected factor premium. The factor premium include the market factor, the size factor such as SMB, the SMB, and value factor, HML, etc. If we use the three-factor model. And the beta, we often use a time series regression to estimate, right? This is a sensitivity of firm's return to the underlying expected factor premium, right? So again, so this approach is not perfect either. So first, the factor premium are not like necessarily optimally constructed, and as I mentioned just now, so even for value and size, it's unclear what kind of risk is captured, right? The initially those are documented as an anomaly rather than a risk factor or and also when we when we estimate the factor, the expected return, we also need to estimate the beta, which can be also very noisy according to the literature. So here I'm just showing that the Fama French factor, the three factors of the five factors, together with momentum, the historical factor returns, right? While in the early period, like before 2014, all these factors produce significant factor returns, right? Positive factor returns, right? All the t-stat are statistically significant. The Sharpe ratio is also kind of impressive, most of them. But if you look at the recent 10 years, past 10 years, only the IMW, which is robustness minus weakness, that is, I think, the profitability factor, still generates statistically significant returns, right? None of the other factor return are still significant, and some of them are even negative, right? So it's unclear. So what this factor return captures and whether that persists, right? So the final type of proxy is what we, it's called characteristic-based proxy. So it's kind of similar, related to the factor-based proxy, except now its estimate use historical regression or realized return on the characteristic directly, and pretty much just use the fitted value or just you estimate the coefficients from these cross-section regressions and then apply this coefficient estimate to the current value of those characteristics, and then that's kind of the projected value that'll be used as the expected return proxy. So this is what we call the cross-sectional, the characteristic-based proxy. So again, similar to the factor-based proxy, so the choice of characteristic here is also there's no uniformly accepted rules, right? People have been using size booked markets, etc. But again, it's unclear whether those characteristics really represent a risk or mispricing, right? And what we saw just now, if those characteristic does not generate significant factor returns, right? It's unclear how well this characteristic-based proxy can perform either. Right? So here I'm just kind of give a summarize the performance of empirical performance of existing ERP expected return proxy according to some research. The first is Easton and Monahan, 2005. They were looking at some implied cost capital proxies, and they conclude that none of them has a positive association with realized stock returns. And the second is a more recent study. So they look at ICC together with some factor-based ERP and also characteristic-based ERP. So they also conclude ICC were not very robust, not very consistent. But they conclude that characteristic-based proxies are positively associated with future stock return in most of the equity markets globally. And finally, so the Lee, So, and Wang 2021, so they try to estimate the so they introduce a framework for choosing among the alternative ERPs when estimate the treatment effect. And they find the ICC and factor-based ERP are not very reliable, and characteristic-based ERP perform the best. So for this reason, right, because the last two paper both showing that characteristic-based proxy have been the best performing one. So we in the paper we're gonna use this as a benchmark and to see whether our disclosure-based ERP can do better or at least as well as those proxies, right? So just a quick just a summary of what we're gonna do, what we do in this paper, right? So what we do is actually quite simple. As we said just now, in the item 1A of 10K filing, company are required to disclose the risk factors they are exposed to, right? So those are those are the kind of factor the manager they assess they believe they are exposed to. So and they verbally explain what is it. So unlike the factor-based approach we talked about just now, size book to market, we don't know what what really referring to, right? What kind of risk that represent, right? Here it has very clear economical meaning, right? So what we do is that we're gonna conduct a topic modeling on the corpus of all risk factors and group them into different groups, right? Or different topics. Each topic represent underlying risk factor. And then we convert those textual disclosures into a numerical risk factor exposure based on how much they talk about this, right? So the underlying assumption is that if they talk a lot about a particular factor, presumably they have great exposure to this, right? So and then so by doing that, we get a numerical risk factor exposure for each firm year, and then we want to test whether this risk factor exposure based on the disclosures capture co-movement risk, right? And after we demonstrate that this capture co-movement risk, we're gonna estimate a risk-based ERP using this disclosure-based risk factor exposures, and we compare this risk-based ERP with the characteristic-based ERP, which we discussed just now. So that was now previous literature conclude that those are the best performing ones, right? So that's kind of the plan, a summary of what we do in this paper. Yeah. So just for those of us who do not know very well about risk factor disclosure, here I give some examples, right? So this is the 10K report for Apple. So as we can see, so the second item on this 10K filing was a risk factor. So this risk factor alone. Oh, a question? Go ahead, Steve.
I believe Yang was first.
Yeah, Steve, go ahead. Yeah.
Oh, hi, Haifeng. So in the item 1A risk factors, there are many risks other than market risks.
Yeah, exactly.
Your model is more like characteristics based. So you kind of like assuming all types of different risks follow that same functional form, which is the linear relationship with the firm's price, right? But like you think about their tail risk, their rare events, and how do you think about that? All the different non-market risk may not fit with the model you have.
Yeah, I guess you kind of raise two questions. One is so beside the market risk, there's also other type of risk. Should they be priced, right? So that's first one. The second one is are the relationship between those exposures and the expected return linear? So I guess those are very good questions. Honestly speaking, so we're not theorists, so we don't have a theoretical model whether all these other risks should be priced or not, right? So so we cannot take an empirical approach. So we assume kind of maybe more than just the market risk gonna be priced, and we let the data tells us which of those factors kind of are associated with stock return, and we're gonna draw on the historical relationship and make predictions. So you're right. Yeah.
It's possible some type of the non-market risk will be priced, but not in the linear.
Yeah, it's cool.
Right.
Yeah, that's also could be the linear relationship. Also, it's a kind of strong assumption, right? That's also the first step. We don't want to like complicate these things too much. Otherwise, we don't know whether the resulting result was due to this more kind of a sophisticated nonlinear machine learning models, or whether it's because this disclosure risk that they're useful. So we kind of just choose a simple linear models to estimate this, right? Yeah. So yeah, thank you. Steve?
Yeah, Haifeng.
Yeah.
I'm a bit surprised that having looked at those benchmark models and seeing how bad they are, and both in terms of how they're constructed and their performance while using those as benchmarks, it seems like that's a bit of a bad benchmark. I say this particularly because there are models which actually employ the accounting data and the risk embedded in accounting data to perform better benchmark models. With the apologies of referring to myself, there's a paper by Penman and Chu in JE 2023 and Penman and Zhang in JBFA that lay out these models, okay? And they beat the socks off all the data dredging models in the standard spanning test. I suggest you use those as a benchmark, because what we do typically think of in accounting is we go to disclosure when the accounting information is deficient, okay? Accountants think first of all, doing the accounting is the best way to approach it, and we go to disclosure when we can't do it through accounting. Now, if you can do it through accounting, but you're looking at disclosure, I think you want to use a benchmark model that actually employs the accounting. And
I see.
And that demonstrates that all of these Farmer and French factors, they're not consistent with the accounting.
Right.
So that would change your benchmark, and so that's what I'd like to see.
Okay. Yeah. Thanks for the suggestion.
Sorry to point from my own papers, but I think that's highly relevant in this context.
Yeah, definitely. It's a great idea because it's kind of, you point out the contrast, right? So here, essentially, it's a disclosure, the verbal textual disclosure. It's not really like the numbers accounting, right? So it definitely it's useful to compare these measures to like the best measure we can estimate using accounting number, right? So like what you done in your paper. So we'll definitely we'll take a look at those papers and use as a benchmark as well. Yeah, thank you, Steve. Yeah,
yeah. So there's a third set of research looking at macro factors. So Steve Ross's arbitrage pricing theory, implementations of that, the dynamic arbitrage pricing theory, and so on.
Right.
So there's a much broader set of models. And then coming back to Haifeng's point about linearity, you could just go back to Farmer-French approach of just having high and low portfolios. Goes back to Ball and Brown. You don't have to impose linearity in your tests, right? There's no particular reason to impose linearity. That's not simpler than just a high versus low portfolio.
What do you mean? So the Farmer-French, like they just estimate the factor return to book to market to size by forming portfolio, but those are not firm specific expected return, right?
True, but you could look at the correlation of each firm to those differences, right? Or you don't have to. You could do a rank regression, for example, instead of a linear regression. You could do a rank regression, which allows for non-linear.
Yeah, we could try those as well. Yeah, So in terms of the APT, right? So that's definitely that's a good point, right? There's a lot of macro-based factor models, but I think that was kind of not so many successful macro-based expect return model people, I mean, were still using. So that's why we didn't really take it seriously. We're gonna do a little bit more thorough literature review to see if you can find any kind of widely accepted macro-based model we can use as a benchmark as well. Yeah.
So just for example, foreign currency risk would be in your risk factors and it's in the APT, but not in Pharma French.
Yeah.
Right? Or the characteristic model, but it is an important risk that's disclosed and discussed. But it's part of the APT.
Yeah, that's excellent point. Yeah, so actually, so this is one of the kind of advantage, right? So in a macro model, you also need to estimate the firm level exposure to, like, for example, foreign currency risk, right? So that's pretty much done by kind of a time series regression. You need to have some macro factors, and then you use stock return like to regress on it and see how sensitive you are. And so one limitation of that approach, you need to use a long history time series to estimate it reliably. But then the company's exposure business model can change, right? Exposure to this foreign currency can also change, right? So if you estimate use last 10 years data, it may not be applied to today, may not apply to the applicable today, right? So even if it captures similar ideas,
right? Pharma French, I don't see why you're tied to a time series approach. If you think it's not good approach, just do the cross-section pooled approach.
It's unclear how we do it, right? Because without the characteristic or without exposure, you cannot estimate cross-sectionally, right? So this will be one approach to give you a quantifiable measure of the firm's exposure to the foreign currency risk, right? So actually, this could be one of the reason, right, why this approach has any value, right? Because you point out very good, you give a very good example of the risk we're actually capturing or the exposure we're capturing, which is foreign currency risk, right? So if we don't use this, I don't know. I don't know of many other better measures. Maybe there's some other measure like look at how much what percentage of the firm's sales revenue coming from international market, etc. So that could be another approach. But this kind of a disclosure-based measure would be an alternative approach, right, to get that exposure measure. That's one of the reason why it works, I think. Yeah. Okay. Yeah. So any other question? Yeah. Thank you. Okay, so here I can just give a quick example, and risk factor exposure actually quite important, right? So as you can see from this this part one, the risk factor disclosure itself kind of it covers more than 11 pages, right? So altogether, this is 17 pages long, right? So there's a lot of space devoted to risk factor disclosures. And there's recent research, Dye et al. 2017, showing that this risk factor disclosure, especially following the mandatory requirement, it has become quite comprehensive and become the length was increased substantially in recent years, right? So what is what kind of a risk they talk about in those disclosures, right? So here, just a quick summary of what kind of risk it can include market level risk, but I think mostly it's more related to the kind of more about a fundamental risk company are exposed to, right? So for example, they're going to talk about how much they're exposed to macroeconomic risk in the section, and what is the business risk. They may also talk about legal and regulatory compliance risk. They could also talk about financial risk. By financial risk, it could include the market risk. It could also include, for example, the credit risk, etc. And there's some other kind of general risk, right? So those are the kind of main categories. So what do we know about risk factor disclosure? There's quite a lot of research has been done in this area already. So first, this first type of group of studies basically conclude that firms disclose useful information in this section, right? So for example, firms face greater risk, they disclose more risk factors, the type of risk firm face determine the portion of disclosure describing that risk type, and equity and debt investor react to those disclosures. But there's also concern that this section may be too long already and boilerplate, so there's not much usefulness here. So especially there's a lot of concern coming from regulators. So I'm not going to repeat or read those sentences here. So our objective is try to understand whether those disclosures are still useful for investors. So we want to we want to develop expected return proxy as we discussed, and see whether that help to predict future expected returns. So we use approach. So as I mentioned just now, we need to have a topic modeling. We conduct topic modeling on those textual disclosures. So we adopt the BERT topic. So this is a methodology that developed by Gutendorf. So it's basically built upon BERT, which everybody has been familiar with. So they basically use BERT to do to extract the embeddings from the textual disclosures. And then, it's basically performing some clustering analysis, grouping all these paragraphs into different groups, right? And use some clustering mechanism here. So I'm not going to go to technical details, right? But hopefully you can get a rough idea. So basically just so the reason we use embeddings because it can capture the underlying idea, meaning of language better than, for example, the previous bag of word approach, right? Like LDA and some other topic modeling. So basically still model this as a bag of words, right? So the BERT, right? BERT algorithm try to understand underlying semantic meaning of language, so that presumably can better capture this relationship between different topics, right? So here, just to give some, Ayun, go ahead.
I have a question about what's your training sample? Like, what are the scope and then the time series fitting to BERT? And then are you able to kind of capture that there's actually changes in the type of a risk people discuss in the risk disclosure section?
So by training sample, you mean
what are the data you fit into the BERT?
The BERT, okay. So the original BERT, so that's already they use, I think Google use Wikipedia and a lot of book corpus to train the base model. So we actually don't have to retrain it. We just use that original BERT. So we just directly use that to extract. We just supply the algorithm with all the each of the paragraph, each paragraph in the 10K risk factor disclosure to this, and they're gonna convert the textual disclosure into a vector, which is what we call embeddings, the numerical vector. So and then this BERT topic algorithm just look at all the paragraph we supply to them, and see how many groups they want to kind of put them into. So the paragraph we talk about similar things, they're gonna put into one group, which are one topic. They'll be classified as topic one risk factors. So there's not much of a training here because we rely on the original BERT. Yeah. Essentially every year, so we do this topic modeling like once every year. Just we put all the 10K filing in that year together to form the group and see how many group, but topic gonna classify, and each firm, how many topic, how many factor they exposed to. Yeah. So did that answer your question, Ayun?
Yep.
Okay, thank you. Go ahead. I can't see the name, so Shuai, go
I have
ahead,
a
please.
question about this model. Do you need to set the number of topics at the very beginning? How do you finally determine the number of topics at the end?
So there is some kind of parameter we can dial to determine the number of topics. But we didn't really play too much about that parameter. So as you can see here, so we just end up have had a lot of parameters. So we tried because ex ante we don't have a great idea, clear idea about how many topics we should classify them to. So we don't basically use a default setting. So they just give us this kind of about 100 like 50 topics each year, but we try to kind of change the number of topics also, but by changing the parameter, and we find the result as robust as long as we don't just limit the number of topics to be too small. So that's, yeah. So if you have kind of any suggestion on like how many topics we should let the bird topic group them, so that we're happy to try. Yeah.
Usually, it's like you have a like randomly select a number of topics, then you try like one by one to see whether these topics are like finally are very separate or like they are still very related to each other. Honestly, I feel like just like trial process. Yeah.
Yeah. So yeah. Then yeah, that's a great suggestion. I'll come back to that your point later again. So there's a couple more questions. I think Xinlei was the next. Xinlei is the next.
Oh, hi, Haifeng. Can you go back to the previous slides on the time trend? It seems that if you look at column 2, the number of topics are monotonically increasing, if I'm not mistaken.
Almost
So,
monotonically increasing.
yeah, do you foresee the trend to be going like this in the future? Does that represent a legit increase in the real topics or the real risk factors, or it's just people becoming more lengthier and there's no real information content?
I guess it's perhaps a combination of the two forces you're talking about. One is just, they want to just talk more about this. I guess there's some research showing that this is pretty much if you talk about risk and then this kind of have a safe harbor, and then you're subject to less of a litigation risk. There's some kind of research on that. So for that reason, company may have incentive to talk more, just like they can later on they say, I warned you this, right? So they'll have a few litigation risks. But there's also more, I guess there's with the business get more complicated. So there also may be more risk factors. As you can see, there's more paragraphs, and there's also some new. I'm gonna show you next slides. There is some kind of risk factors which was new. For example, the Ukraine-Russia risk. Perhaps also the Bitcoin or cryptocurrency risk that was also spotted by the bird topic, which perhaps didn't exist before. So I guess it's a combination of both. Yeah.
Right. How does that impact the bird predictive power in a sense? Is it going to be more predictive in recent years, or just?
That part I'm not clear. So if it is more driven by the boilerplates, just to provide, just say more without give much of substance, I guess that will reduce the prediction power. Otherwise, like if it is driven by informational disclosure, that could help. That would be kind of my guess.
Yeah, thank you.
Okay, yeah, thanks. Peter, please.
Hi, thanks for the presentation. I'm just wondering about the identification of the topics. You're pooling the whole cross section into the BERT topic analysis year by year, right?
Yeah, we did by year and without like considering there may be some continuity here. So that's what we currently do. But there's also we have been trying like every year we kind of maintain the topic we identify in the past, but use as a base, and then we continue adding new textual text into every year. We may have more topics coming out, so it's alternative choice.
So my question really is relating to the distribution of likelihood of topics within the cross-section and whether pooling in the cross-section is the most powerful way, because you think of some industries, for example, which will have high exposure to certain risk factors. But some of them may be quite small industries and therefore get proportionately less weight in the topic modeling. So, I guess ultimately the question is, if you were to do this across by say sector or industry groups, would you end up with a different set of topics?
I guess it would. Frankly speaking, so here, for example, we're already identifying maybe like on average 50 topics, right? But you can imagine that it's probably does not cover all the detailed topics, right? There's some kind of topic. There's not so many firms talk about it. There will be another kind of a kitchen sink group. It's all other. So that's related to what you say, right? So if there's some industry for certain industry, even perhaps the industry does not have too many firms, but they are subject to all of the firm in the industry is subject to certain risk factor. So we could potentially get a different risk factor disclosure if we apply this per topic in the industry level.
You may be just ignoring or losing sight of some important topics for relatively small groups of firms. So I think it's just a question of power, really.
Yeah. So it's also a balance, right? So there's another thing we are currently trying to experimenting, right? Because for some risk you can imagine maybe some risk are more like macro level, basically everybody's subject to, and some risk are kind of firm specific, all the firm in that industry subject to or exposed to, and some risks are really idiosyncratic, right? So at this moment, so perhaps most of the risk factor we capture are kind of more on the global level, on the macro level. So we could also another thing we're trying to we're kind of working on whether we can kind of get a better classification. We got identify both the macro level, industry level, and firm specific level, and see whether they have different implications, right? That's kind of related to what you suggested, right? So when we look at all of them together, we certainly lose some information. Yeah.
Thank you.
Okay. Yeah. Ayun, go ahead.
So related to kind of like your discussion with Peter is even for macro, right? Some firms will have positive versus negative relationship with the macro factor. So
yeah,
are you able to kind of disentangle the two?
No, we actually can't. So that's another limitation. So here
that would cancel out, and on average, professionally, maybe it's insignificant, right?
Yeah, I guess so you're thinking about like a beta, right? Some company may have positive beta, other have negative beta. Yeah. So one limitation of our approach is that we won't be able to identify negative exposure at the raw level, but we can only identify, some firm talk more about it, some firm talk less about it. So basically, when we find they talk more about it, we assume they have higher exposure to this risk. But we don't get the like negative ones. So our current approach.
Okay, so still
maybe we can,
disclosure volume driven, because I feel like your paper need to distinguish a little bit from Eddie's paper published in TAR, which is just purely disclosure characteristics, whether certain risk factors are included or excluded from the risk disclosure section. But if your measure is just based on the frequency of discussing a certain risk disclosure, that's kind of like a refined measure, but not really capture the numeric relationship.
Yeah, so that certainly is a limitation. So related to what you mentioned just now, we were thinking about in the past, we think about also look at the tone. Let's say, well, they both talk about some underlying risk. Some talk more positively, some talk about more negatively.
Yeah.
But the problem is that we see most of those risk factor disclosure, they are not in positive tone. So we may not get what we want, essentially like positive negative thing, right? So, but that's definitely a limitation, and we'll think more. And if you have any kind of idea.
I think one way to solve that problem is that if you just use Google's BERT, you don't really need to limit your disclosure to item 1A. Their MD&A may have other discussions that is more upside, right?
Yeah, but those may the discussion about their performance, etc., rather than just really their underlying exposure to certain economic shocks. So that's we want to focus on the risk factor disclosure section, right? Because we want to capture their exposure to risk rather than some other sentiment or some other like performance driven tone.
Yeah, but I think that's kind of like the researchers' predetermined assumption that if you're throwing MD&A, will you find better results in terms of explaining returns? Maybe.
It could, we could, right? Just like the sentiment and the MD&A. If our only purpose is to forecast future stock return, I agree with you. We could potentially get even better, right? Because we're gonna fill in more information, and that part is more forward looking, maybe. So it could be the case. Yeah. Okay, thank you. So those are the example of topic in 2021. As you can see, there's as I mentioned, that they identify new factors, but there's also, for example, they talk about I guess the stock market risk, right? Price risk. They talk about the exposure to here pandemic risk. There's also kind of a new. There's also internal control risk, currency risk, interest rate risk, etc. Right. So those are all they do seem to have a kind of interpret or economic meaning, right? So another related to the discussion just now. So as you can see here, about internal risk, internal control risk. Here is also about internal control. So perhaps we didn't have a perfect or optimal number of risk factors, but so that's why later on we also try to combine or reduce the dimension of risk factor by using this PCA. So as I mentioned before, so this the risk factor exposure basically just a vector of topic with which that with each element equal to the proportion of text that related to this topic, right? So if they talk more about this topic, we assume they have high exposure. Otherwise, they have zero or less. So then we try to understand whether this risk factor exposure capture the sensitivity to some underlying economic shock. So if they capture sensitivity to underlying shock, what we expect is that we would see that firms with similar kind of risk factor exposures, they tend to commute. They tend to commute not only in stock return, but also in some other kind of fundamental ratios like valuation, like profitability, etc. So therefore, we construct for each company firm year, we construct a risk-based peer, which is a number of companies with very similar risk factor exposures. And so here we just look at the top 10 firms with the highest similarity, risk factor similarity, exposure vector similarity as a risk-based peer. So the top 10 risk-based peer here, we rank them from 1 to 10, 1 being the highest similarity. So as we can see, as we go down through the list, the percentage of peer coming from same industry decrease, right? So it seems to the level of similarity kind of align with the industry membership. But we can also see that even the ranking number one, the most similar peers, not all the peers come from same industry, right? So it's captured something different from industry, I guess, yeah. So then we look at the return co-movement, right? So how much this risk-based peer return explain the focal firm's stock return. So we look at R squares. So here we look at the equal weighted risk-based peer, just the portfolio, the 10 firm, which is equal with them. The second is cosine weighted, the cosine similarity weighted risk-based peer, but result is similar, and we compare to this industry-based peer. So as you can see, the R square of them, the regression of firms return on the peer firm return, they're always higher for this risk-based peer than industry peers. So it doesn't matter which industry classification we use, and we always got this. So this actually capture co-movement better, return co-movement better than industry peers. So we also look at the fundamental ratios co-movement. We look at price to book ratio, EV to sales ratio, PE, and profitability, like return on net operating asset, ROE, asset turnover, profit margin, leverage. So in all these cases, we can see that this risk-based peer has significantly higher kind of R square than the industry peers. So basically, risk-based peer explain much more cross-sectional variation in those fundamental ratios than industry peers. So that kind of gave us confidence that this risk factor exposure captures something economically meaningful rather than just some noise. So then we estimate. Are you gonna have a question again?
I have a quick question about industry peers. So
Yeah.
Do you expect that firms across different industry, but along the same value chain or supply chain, would talk about similar type of risks, right?
Yeah, that's one. That could be one of the reason. Yeah, and there are also kind of maybe also one is a supply chain relationship. They will be subject to similar risk, right? The other one could be also business model. Yeah, the other one could be also business model. For example, if you sell luxury, watch, right, or jewelry, you may even if you belong to different industry, but you may talk about similar risk exposure, like to, for example, luxury cars or whatever, right? So that yeah.
Demand quantile.
Yeah. Thank you. So then we estimate the risk-based ERP. So we did it quite simple. So because as we see from the previous figure, there's some kind of individual topics are actually quite capture similar thing underlying. So there may be some redundancy. So we perform this PCA on this risk factor exposures and only keep the first 5 principal components. So then this will be essentially, we kind of assume there's underlying 5 unique underlying risk factors, and those the 5 values will represent their exposure to this 5 underlying risk. So now we conduct cross-sectional regression of monthly stock return under standardized principles. So then essentially, the slope coefficient from cross-sectional regression can be regarded as a factor premium to that risk factor, and then because the exposure the standard exposure will be the exposure to that and affect the factor. The product of that two will be the factor return. That will be the expected return this firm should earn to compensate for that risk, right? So we sum up all these 5 individual factor returns together. So that will be our expected return proxy. So we estimate this each month, right? But the monthly estimate, you're gonna have noise. So therefore we look at a past 12 months average, moving average. So use that as the expected return for the future and see whether this expected return proxy are associated with future stock returns.
All right, Haifeng, we have 5 minutes left.
Yeah. So I'll just quickly discuss the results. So here is a characteristic based ERP. So we talked about this method before already. We look at several benchmark, LPV, JLR, CER. The only difference is their choice of the characteristics. So LPV is booked market ROE return volatility. So this is what so they at all 2022 they use, and the other one I'm not gonna talk too much about it, right? So but those are also the models proposed by the previous study. So you can estimate characteristic-based ERP using this approach. So when we compare, we look at a cross-section correlation between ERP and future realized returns. And we look at slope from a cross-section regression of future return on ERP for both the raw ERP and the standardized ERP. We also look at R-squared, but R-squared to us is not extremely meaningful here. And we also look at the future return spread between extreme decile ERP. And also look at their kind of measurement error variance as Lee et al. Calculated. So here the descriptive, perhaps not too much information, but we can see that this risk-based ERP actually have higher variance than compared to slightly higher variance than others. But both all the variance are lower than the realized return, right? That's not a surprise. Right? So here, this is the main results, right? So we can see that here, this is a cross-sectional correlation with the future realized stock returns. So the risk-based ERP has the highest cross-sectional correlation, and slope coefficient is not a highest in terms of magnitude, but the t-stat is the highest. The reason that this is not highest because as we can see here, this is the standard deviation is higher. So if we standardize all of the ERP measures and then run a regression, this one got a much higher slope coefficient than any others. The R-square, as I mentioned, is not extremely useful because some of the coefficient can be negative and have high R-square. So in that case, high R-square doesn't really mean much things, right? But here, this one is a return spread. Again, we can see this risk-based ERP has highest return spread, no matter we look at equal weighted basis or value weighted basis. So none of the other characteristic-based proxy generates statistically significant return spread or hedge returns. The last one is the measurement error variance. For this one, smaller is better. Smaller measurement error is better. So we can see that this one is smaller, but it's not really kind of negative. Which will the Lee et al. Paper that suggests preferably a good measure should have a negative MEV. So here, because this we don't find a strong result for the characteristic result, characteristic-based measures. So it's kind of inconsistent with the existing literature. We want to understand why. So here is like we redo this analysis by only using data before 2008. We can see all this characteristic-based measure has performed extremely well. So it's more like time period sensitive. If you look at the recent period, none of the characteristic-based measure works very well, but the risk-based peer still works fine. Subsample result is very similar, so not much to talk about it. And subsample result of the characteristic-based measure again. in small firm, among small firm, it appears to work sometimes, but most of the time it doesn't work. Yeah. So when we look at the previous result, we only look at the next month's return. If we look at the second month's return, skip by 1 month, again, the results are similar. So the risk-based peer still significantly correlated with the second month ahead stock return and third month stock return. So they outperform all the characteristic-based measure. And then we look at, in our main measure, we look at the last 12 months average. So if you look at the last 6 months and 9 months average, moving average, it's actually, we get slightly better results, right? So look, at least it's robust to a different kind of a moving average window. We also, in our main measure, we look at top 5, first 5 principal components. If we change to top 3, top 10, top 20, top 30, actually kind of robust. Slightly weaker if we have too few principal component or too many, but they're kind of robust. Yeah. And then last piece, we want to look at incremental usefulness of risk factor disclosure versus the characteristics. So we add first 5 principal component to this characteristic-based measure to see whether we have higher kind of a return R-square from realized return regressions. So that's analysis that done in this accounting real paper. We find this the risk factor disclosure proxy increase the R-square significantly. If we just throw in all the individual risk exposure, like perhaps 50, 60 measures, so we also still see high increase R-square, but the magnitude of increase is smaller, suggesting maybe if we don't do any damage reduction, we include too many risk factors there. They may be they may contain a noise. They may also, if you have too many regressors, you may also have some statistical issues, right? So, but we see some improvement, but not as big as before. And last one, we just put them all together in the same regression and get a predict component of characteristic-based component and risk-based component. We can see that both seems to load, but the risk-based measure seems to have a stronger association with future stock return. No matter we look at the first 5 PC or the individual risk factor exposures. So suggesting that this, so if you look at 2 year, I guess this is 2 year ahead, 3 year ahead. So 2 year ahead is stronger, right? So 2 year ahead regressions, only risk component are still significant. 3 year ahead, the same. Only the risk disclosure component are still significant. Those characteristic-based component no longer predict stock returns. So this is the pharma fringe factor characteristics result are similar. So basically, just showing that the risk disclosure-based components are very robust, but the characteristic-based component are less robust. So that's pretty much all I have. Sorry for going over a bit of time. So thank you very much again for having us here. If you have more questions, I'm very happy to stay longer to discuss. Yeah, thanks.
Haifeng, do you
All
have
right, thank you, Haifeng. Just as a reminder, our next event, I already put it into the chat box. Yeah.
Yeah, I have.
Perfect. Thank you, Haifeng. Right. Thanks everybody for
much.
attending, and thank you for the wonderful presentation. Feel free to stay longer if you want to discuss with Haifeng furthermore. Yeah.